Hello there everyone, today's video I'm going to talk about the tax treatment of insurance payouts. Basically the gist of insurance payouts are that they are taxable. The rules are generally that you pay insurance premiums and it's a regular expense of your business. That is tax deductible, but the reason it's tax deductible, yes, it's an expense, but also when it pays out, then that is generally taxable. Yes, there are some exceptions, but for the purposes of this video, assuming that insurance is taxable on the payout. Now, next question is, how is it taxed? And the answer to that is, it depends on what the compensation is for. So that insurance payout, is it for loss of income? So you're being compensated for loss of income on the insurance payout. If you are, then that is taxed as an income receipt. However, if the monies received from the insurance company are specifically for the repair or the replacement of an asset used in your business, then that is a capital gains tax play, not taxable as income tax or corporation tax. So let's have a little example. So capital gains tax, I think most people wouldn't assume that an insurance payout is subject to CGT. You got to sell something, right, before CGT is in play. No. Insurance payouts that are used to replace or restore an asset, that is subject to capital gains. So let's have a little example of good old Mr. X, 100% shareholder and director of ABC Limited. Now, he bought a building in his limited company for 200,000 way back when. Now, the building is worth 500,000, 500,000. Oh, but he's just had a fire. Bit of a shocker there. So the fire has damaged his building. It's not gutted it, but it needs a bit of repair work. So puts a claim in with the insurance guys, and he gets paid out 60 grand from the insurers to go towards, this fire damage of the building in his limited company. Okay, so like I've just said, that is actually, it's not for compensation for loss of income, it's to repair the building. So that throws up the capital gains tax regime, and we have to do what's called a part disposal. So we have to take that 60,000, and it is taxable, but it's taxed under the CGT rules, not just a straight miscellaneous receipt of income in his profit and loss account, taxable at corporation tax rates. Now then, how we do that CGT calc, it's called, in the CGT jargon, a part disposal. And we have to use the good old A over A plus B fraction. What the hell's that? So that is a fraction that you use in the capital gains tax world when only part of something is disposed of. So in other words, we deem this building to be part disposed. It's still there, it hasn't burnt to the ground, but for the tax purposes, we deem there to be a part disposal. And in this calculation, this A over A plus B, which I'm going to explain more of, the A in our fraction is this 60 grand, that's the insurance payout, and the B is the value of the property just at the point of it was having the fire, which was 500,000. Okay, so bear that in mind, and then we go straight to the CGT calculation. So any CGT calculation always starts with the same thing, sales proceeds, or deemed sales proceeds. Remember, in this case, he's not sold anything. He's still got the property, but we have to do this CGT calculation nevertheless. So, deemed sales proceeds, £60,000. Now, this is where our funky fraction comes in. So, normally in a CGT calc, you go proceeds less cost. So, the cost is £200,000, but we have to then apply this fraction. So like I've said, the A and the B, so we'd say 200,000, and then this A over A plus B fraction, 60,000 divided by 60 plus 500,000 gives us a deemed cost associated with this 60 grand receipt of 21,429. 21,000. So what is he left with? He's left with a taxable gain of 38,571. So that's just the 60,000 that he's received less this cost in the CGT calc based on this A over A plus B fraction, and he's left with a taxable gain of 38,500. Then the base cost of the building that's still there for a future sale, let's say he does sell it to someone in a few years down the line, whatever it cost him originally, 200,000, that's reduced by what's left, the difference between the 200,000 and part of that cost using this calculation, which is 21,429. So you can see, in effect, looking at the big picture, without getting bogged down at the CGT detail, you've received 60 grand. And I'm saying, prima facie, on the face of it, you've had tax relief on the premiums, you've got to pay tax when you get it. But because it's to compensate for fire damage, it's subject to the capital gains tax regime. So it's still taxable. And all this is doing really is the timing of when it's taxable. Because we're saying, of the 60,000, 58,571 is taxable now. And the balance of that 60,000, 21,429, is taxable down the line, could be years down the line, when he sells the building. So he's still getting taxed for 60 grand. It's just the timing, 38 grand there, 22 grand there, not all in one go. And it's done under the capital gains tax regime. Now, of course, corporates pay corporation tax on capital gains. They don't specifically pay capital gains tax, but how you work out the calculation is the same if this guy had been, say, a sole trader. So that's how it works. I think, like I said, most people would just assume that if the thing was taxable, it would just go in the profit and loss account, as it would do if it was to compensate for loss of income. 60 grand, pay your tax at CT rates. Well, no, what happens is some of it goes in now and some of it when you sell it down the line. And you come up with this convoluted formula to get this very precise amount of 38,571 now, the balance when he sells it down the line. So there is also a rule, however, as an extension to this basic principle, that if, let's say, I've assumed in my example that he got his 60 grand, but he actually didn't need all that 60 grand to do the building up. Like I said, it wasn't burnt to the ground. He got the decorators in, a couple of plasterers. He didn't spend anywhere near the 60 grand. So the expenditure would have gone in his accounts as repairs. Okay, but HMRC say this, they say, look, assuming most of what you get in the compensation is actually used to restore the building, you can actually choose to defer the capital gain until the building is sold in the future. So that 60 grand that he got from the insurance company would not be taxable, some of it now, some of it later. It would all be taxable later. And he would also get tax deduction, of course, for the amount that he spent in doing it up at that point in CGT, because it would be capital expenditure, unlike repairs expenditure that we're saying in this example. Which, if you look at it big picture, that seems fair, that stacks up. It's like saying, well, okay, you're still going to get taxed for your 60 grand, but it's all about capital. You used that, all of that payout on capital expenditure, so we'll let you pay the CGT when you actually sell the building, which could be many years down the line. If you receive the money and you didn't use anything like the amount that you received, then we want a bit of tax now, and that's how they do it. So just an overview there on the nuances of taxing insurance payouts. It's a little bit to think about. It's not just a question of it ain't taxable. Well, yes, it is. Or if it is, it's not just taxable on the full amount. It's depending on the nature of the payout and how it is applied. How much of that payout did you use to restore your assets? So there you go. So if you like this video, please do subscribe. And as always, I'll see you soon.